In this episode, we're going to dig into how do banks invest their money, how do banks make money, and how you can act like a bank. Hi, everyone. Welcome to Control and Compound. I'm your host, Darren Mitchell, and with me today, Christina Wyatt, wealth coach at Control and Compound Financial. Christina, how are you?
Hey, Darren, I am doing great. How are you doing today?
I'm doing fantastic, thanks.
Awesome. Well, before we get started, I just want to remind our listeners that if you are listening on your favorite podcast platform, you're going to want to subscribe and leave that 5-star review. And if you're listening on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out.
Thanks, Christina. Okay, so we're going to talk about banks, how they make money, the history of banks, all that stuff. Where do you want to start, Christina?
Say we start from the top, Darren. Let's go back historically and take a look at where did these banks come from?
Oh, I love this, and you know, I remember studying this in university, and now with the Bitcoin revolution, you know, our last talk we had on that, you know, people are talking about that. But if we go way back in time, you know, there used to be bartering. You'd trade your chickens for cows or whatever, and then you know, eventually gold and silver kind of became the currency. So people would have gold and silver, and they'd exchange a piece of gold for a cow or a couple pieces of silver for a chicken. And then they kind of created these like depositories where this like building would house all the gold, and you'd come in and you'd give your gold and silver to the depository, and they'd give you a note saying, you know, you got 2 pieces of gold and 10 pieces of silver, and you had that note. Then it'd be a week or two later, it's like, I need some money to go buy some whatever for the cows. You go back to the depository, you'd give them their note, and they go, what do you want? And they're like, I need 2 pieces of silver. They'd update your note, they'd give it back to you. So this was going well. But then these depositories, they're like, you know, they're smart guys. They go, wait a minute. People now aren't really coming back for their gold, because what happened is people started exchanging these pieces of paper and said, hey, I got a piece of paper that says I got 2 pieces of silver with a depository. How about I give you that for your chickens? Oh, okay. So they started trading these papers. So these depositories were going, people aren't coming looking for their gold. Maybe we can loan this gold out to someone else. So they started taking the gold and the silver in their depositories and giving it to other people. And then those people would pay them interest on that. And then they were like, well, why are we loaning out the gold? Why don't we just loan out this piece of paper and say, let's loan out this piece of paper, and, you know, we're going to back it because we have all this gold. And this is how kind of money created. Now, money got really started. The banking system got started. So they were loaning out money they didn't have to people that thought they had the money. So if that happened, if an individual did that, Christina, if you or I did that and said, we're just going to loan out money we don't have, what do we call that?
We call that fraud, Darren. We would be in trouble for that. They call that fraud.
So if you try to do that on your own, you're going to go to jail. If you do that and you're in the banking world, you're going to get promoted. But you know, that's an oversimplification. But that was kind of the genesis of how the banking system really got started. So that's kind of how banking got started. And then you know, you always got to remember from a bank's goals here, the banks really have 3 wants. And Christina, what are those 3 things that every single bank in the world wants?
Yeah, Darren, there's those 3 things. They've definitely come a long way since they first started. And they have 3 big wants from all of us. They want us to deposit our money systematically. So they want our money systematically. They want to hold our money as long as possible. So they want to make sure that they hold it. And then they want to drip that money back out to us pretty much as slowly as possible on their end, right? They have 3 big wants. And how do are they achieving these wants at this point in time? I would say absolutely, because when we look at those systematic payments, well, the majority of us out there, we are all depositing our, our weekly or biweekly paychecks into those bank accounts systematically. So they're achieving what they want there. Then, you know, the majority of people out there are putting their money into an RSP, locking that up until they're 71 years old and not touching it. Well, I would say that's holding on to quite a while for the banks to be able to hold on to your money. And then they drip that money back out to you. And that is through those, you know, those RIF payments, the systematic RIF payments that you take back out at when you're 71, when you're in retirement. There's nobody out there cashing out their whole RSP and taking it in one chunk because they're not going to want to pay those taxes. So they've figured it out. I feel like they've come a very long way since the beginning. They've got a strategy here, right?
it's a brilliant way to make money. Like, we give the banks a hard time sometimes, but it's a brilliant business model, to make money. And like, again, up to your point, Christina, you could be 20 years old getting your first job, starting your RSP or your 401k in the States, and it could literally be with them for the next 80 years. Eventually you're going to start, maybe at 60 or 71 or whatever, start taking pieces of it out, but you're not going to take it all out. So they could literally have your money that long. And, again, it's right in our name, the first word, control and compound. They're in control of your money for 80 years. You are giving up control of your money for 80 years. Crazy.
Absolutely. It is, they've got the control. And question, is this what they do with their money? Are the banks doing the same thing with their own money at the end of the day?
Oh, rules for thee and not for me. I see where you're going with this. Yeah. Well, let's see. I mean, in the U.S., it's pretty easy because you can go to the FDIC website and you can actually punch in a bunch of things and you can figure out what the banks are doing, right? So we don't kind of have that accessibility in Canada to see exactly what they're doing. But in the U.S., we can look and say, okay, well, like if you look at Bank of America or Wells Fargo or some of these big banks, some of these banks have cash value life insurance on the books. And when I say cash value life insurance, I don't mean a little, like $20 billion. I think Bank of America and Wells Fargo is just about there. $20 billion. And all the banks have it. Why? Because cash value life insurance is a perfect place to store your money, guaranteed to go up, can't go down. There's a death benefit, all these great, wonderful things. So, even the Canadian banks that operate in the U.S., you can look up some of the Canadian banks. We get a couple of Canadian banks like $1, $2, $3 billion in cash value life insurance, and that's what they're disclosing in the U.S. So, at the front of the bank, they're telling you put your money in an RSP in a nice mixed basket of mutual funds and leave it there for the next 80 years. But what the banks themselves are actually doing is, for a lot of their money, their tier one safe money, they're putting in cash value life insurance. So, again, we want to figure out kind of how to operate like a bank. You need to understand what a bank is doing. Right, Christina?
Yeah, exactly. We need to know what they're doing so that, as we did say, they have a good business plan. They have a very good business strategy. And we always say we want to do what the wealthy do. If you do what the wealthy do, why reinvent the wheel? And the banks have got this figured out. So that's why, you wrote the book, Be the Bank, so that we could all learn what the banks do. So I think that we should kind of go through an example of exactly how the banks make their money, kind of simplify it. We're going to bring up a couple slides and go through this one step at a time, exactly how they do it. But while we were getting ready for this podcast, I was going through a few things and I found a quote and I wanted to share it today. It's Henry Ford in 1922. And he said, "It is well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning." I think that's saying something there, right?
That's a great quote. I love it.
All right, so let's jump into how the banks make their money, how this works. So we're going to share.
Okay,
some
and for those of you
slides
that aren't watching on YouTube, we'll walk you through the numbers as we go along. You can listen and we'll make sense of it for you, or you can check it out on YouTube. Either way.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
All right, so we've got the bank here in front of us. We're going to go through how the banks actually make money. So how does this work? Well, we're going to start with Tom. And Tom has $100 and he's going to deposit $100 into the bank. Then what's going to happen is the bank is going to lend Jane $100. And, it could be through a credit card at 20%, a car loan at 5%, a mortgage at 6%, or a line of credit at 12%. They're going to take that $100 and lend it out to Jane. Jane is then going to pay the interest back to the bank for that loan, right? So let's say out of all these ones, we'll just make it simple, and we say that Jane is going to pay 10% back to the bank to repay for that loan. Now, what do you think the bank's going to pay Tom, Darren?
Probably zero with service fees every month. That actually makes them, lose money. No, they'll pay him a tiny little bit. What do you want to use?
So we're going to say that they're going to pay Tom 1%. I think,
Okay.
most bank accounts aren't going to pay that, like you said. But let's say they're going to pay Tom 1%. So what essentially has happened here with the bank?
Banks made a bunch of money. They made 10% and they only cost them 1%.
Exactly. So when you're looking at this, it looks as if they've made a pretty darn good return, right? They've made a 9% rate of return by taking Tom's money and lending it out to Jane, charging Jane a higher interest rate and paying Tom a lower one. So the majority of us would think that, yes, they have made a 9% rate of return. But is that in fact true, Darren? Is that how much they've made?
No, and this, when I first learned this years ago, this was like what? And I found the simplest thing to do is try to take a dollar amount, and from a dollar amount, Tom earned $1 of interest, so the bank paid $1 for the use of Tom's money, and they loaned it out to Jane for $10. Okay. So if you were a business and you bought your whatever product for $1 and you sold it for 10, well, you made $9 on a dollar investment, and that's a 900% return. A 900% return. Invested $1, got back 10, made 900% return. And so do they stop there, Christina, and just loan it out one time?
No, absolutely not. They have Tom's money lent out 7 times over, right? Like you said, they had the gold to back it up, but they've actually changed the rules on that gold backing as well, right? So they don't actually need the gold in their bank accounts to be able to loan out this money, which I guess is a whole nother story. But no, they can loan it out as many times. Well, I'm sure there's some rules and regulations around it, but they definitely have it loaned out more than once. That's for sure.
Yeah, so they're loaning it out on the credit card, on the mortgage, on the second mortgage, on the line of credit, on whatever else, multiple times. So that 900% return gets magnified, multiplied, velocity of money, keeping their money in motion. Again, brilliant business model, and we want to mirror what they're doing.
Exactly. So I think we're going to take a look here at how we can be the bank, right? And what we talk about on a regular basis. How do we become the bank in this scenario and cut out that intermediary here that's making those returns? How do we multiply our dollars, and how do we become the one making that 900% return at the end of the day, right? And I think we're going to go back to the cash value life insurance here on this one, and how we can use that as a tool to be able to do what the wealthiest do, right? How can we be like the bank?
Yeah, and I think here, Christina, like, this is a real world example. Like, I know someone who did this exact same thing we're talking about, and this guy was, he didn't have any hair, but he was very handsome and really knew his infinite banking stuff. Okay, it was me. No, this is I actually did this actual example last year. So, I had an opportunity to be to loan money privately. It was a real estate development that I loaned money privately, and I loaned $100,000, and they paid me 15% interest. So again, I want to be the bank. I want to act like a bank. So I didn't use my money. I used the insurance company's money. I borrowed $100,000, and they charged me, it was just under, but let's say 5%. So I paid 5% for 100,000, 5% on 100,000. And I loaned it out at 15. So again, if we didn't do the last example, I'd say, well, 15% I made minus 5% I had to pay. I made 10% on my money. That's a pretty good return. But that's not it at all, because again, put the dollars back into it. I paid $5,000 in interest, and I got $15,000 return. I tripled my money. I made 10 grand, and I tripled my money. Okay, That's it. And the whole time I did this, what happened to my cash value life insurance policy? How was that affected, Christina?
It was not affected, right? It continues compounding. It continues growing. Whether you have a loan or you don't have a loan, it's going to grow the exact same way, right? So on top of this, you've done one better than the bank because you actually have a return growing inside as well. So you've got your dollars working outside, and you also have your dollars working inside of the policy, earning that, around 5% return that we're seeing inside of these policies on top. So we haven't even added that here on the screen is what you made inside of the policy. You've got a $10,000 gain just on using somebody else's money, right? Which is a concept we hear about a lot, and how many become very wealthy is using somebody else's money. Having your own bank allows you to do that, right? You're able to take advantage of those opportunities. And again, it's not just one opportunity, right? Because if whatever cash value you've got in there, you can borrow and you can lend it out to multiple people if you want, the exact same way, right? You've got the ability to do that because you're in control of your money.
Yeah. So, I mean, the possibilities are infinite. I can use this for a down payment on a property. I can use this for buying the stock market when it goes to zero next year, or I could buy it to buy Bitcoin. Whatever opportunity I see, the possibilities are infinite. And I want to go back to, the being a bank here is that loan that I took. Well, I'm the banker. And when you're the banker, guess what? You get to set the rules. So I set the rules on that loan. I'm the only one that can change that loan. I'm totally in control. So I can pay that interest back when I want, how I want, and if I want. Now, it's not a good strategy not to pay it back, but if I don't want to pay it, in this case, I didn't make any payments for a year. I just said, you know what? I'm going to get my 115 grand next year. I'm not making any payments. Just let the interest accumulate. Great. I could have changed my mind 3 days in and go, you know what? I got cash sitting here. Why don't I pay off that loan? Okay. Or I could have said at the end of the year, all right, I'm going to take that $115,000 back, but I'm going to do something else with it and not repay my policy loan. Why? Because I am the bank. I'm making all the decisions that typically a banker would make. When I needed to know, I didn't have to go to the bank and say, this is what I want to do. This is why I think it's a good investment. This is why you should loan me money. I looked in the mirror and said, hey, Darren, you want to loan $100,000 to this real estate investor with this incredible backing that you have for the loan? I'm like, yeah, Darren, I do. And that was it. I called the insurance company and said, hey, I need $100,000 of your money. And they said, sure. They didn't ask what it was for, when I was paying it back, how I was paying it back. So again, just one example of the multitude of things that you can do when you're in control of your money and when you can act like a bank.
Yeah, one other thing too that we didn't include here that's important to mention is that when you're using these for investment purposes, your interest is actually tax deductible. So at the end of the year, you're going to get some of that 5% back as well. So you can include that, your return just got a little bit better on top of what we're already seeing here.
And we didn't include, well, what else is our dollar doing? Yes, it's in the policy growing unaffected by this loan. And yes, it's over here taking advantage of this opportunity, in this case, a loan. But it's also providing a death benefit in case something happens to me. My family's going to get a big old, tax-free check. The loan's going to be paid off from the death proceeds. So again, multiplying your money, having your money doing different things, and being in control. I want to act like a bank, and for me, infinite banking is the perfect strategy for us to act like banks, and that's why we help Canadians coast to coast doing this, because we want everyone we deal with to be their own bank, to give them this opportunity to act like a bank, to become so very profitable.
Exactly. We want to be like the wealthy, do what the wealthy do.
Excellent. Okay. Thanks for watching. Thanks for listening. That's how you be the bank. Please reach out if you want to learn more. Have a great day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controlandcompound.com, and you can sign up for an education session with one of our wealth coaches.